Hey, welcome back. We just finished going over sections 1 and 2 of Unit 2 in the first video, and in this section we're going to go over, section 3. So we already talked about what accounting is, the different types of accounting systems, how to set and obtain career goals, accounting as a career, and now we're going to look at kind of how accounting, go a little more into detail about how accounting helps businesses make decisions. We're also going to look at different types of businesses, like business structures and different types of business ownership, and then we'll discuss the accounting assumptions. So here we go. Okay, so again, we mentioned this in the previous video that the aim of every business person is to earn a profit from the business. And I know some of you might be like, well, what about nonprofits? Well, even they need to make a profit in order to keep going, to pay their employees, and to just kind of keep the business running. They need to be generating a profit as opposed to a loss. But in business, there's always the element of risk called loss. So by maintaining an accounting system and recording all financial transactions, this will help determine profit or loss in a business. So again, the profit is the excess of revenue over expenditure. So when we are bringing in more money than we are putting out. And then loss would be the excess of expenditure over revenues. So spending more money than what we're actually bringing in. All right. So we're going to get into talking about businesses, and the text wants to give you kind of a brief overview of like how businesses are started, and it is usually started by the entrepreneur. An entrepreneur is one who undertakes and operates a new business venture. They assume accountability for the risks involved. So when they take on a business, they're taking on also the liability that if that business goes under, they could lose money. Pros of being an entrepreneur: you are the boss of your business, so you don't have to answer to anybody else. You can work at your own time and your own pace. You have full control over business decisions, and you can enjoy the rewards or the profit. Some cons: it can take really long hours to get a business up and running. You must meet the business costs, so a lot of times that's coming out of your own pocket to put money into the business. Mobilize costs from your own sources. Again, that's just kind of like when we talk about startup costs or expansion. It's going to be money from your own sources in order to get that going. And as an entrepreneur, you must bear the risk loss in your business. So if your business does fail, you're the one that will be suffering the loss of that business financially. Okay, types of businesses, or like kind of structure of businesses. There is the manufacturing business. A manufacturing business buys raw material in order to produce their product. So then they take that product and they sell it in the market. So an example of this would be like Ford. They manufacture and make their own cars. They might buy different parts, but they manufacture it and put it all together to make their own product. Merchandising businesses, however, they have a business person that buys a finished product in bulk from the manufacturer. So a lot of times you might see car dealerships that buy a bunch of cars from different manufacturers and then sell them all in one place. That would be the type of merchandising business. Sells in smaller quantities to the end customer. And I also think of like, Walmart buys things in bulk from its suppliers and then sells it in smaller quantities to the end consumer, which is you and me. So an example would be retail stores, Walmart, PacSun. Again, those are businesses that buy things from the manufacturer in bulk and then sell them in smaller quantities to the end consumer. Then we also have what are called service businesses. These are businesses that provide service for a fee. So like a doctor, a hairstylist, there's lots of service industry type businesses. Okay, forms of organizations / business ownership. So your text talks about the three main types of business ownership, one being the sole proprietor. And if a person is a sole proprietor, that means they are the single owner of a business. There are some advantages and disadvantages to this. Some advantages include there are few formalities required and it's easy to start, meaning there's not a lot of legal work to get a business started with just you. You have tighter control over the business, faster decision making because it's your decision. So you don't have to go counsel a board of directors or run it by several partners. You get to make the final decision, so it's a much faster process. And you get to enjoy all the profit by yourself. You don't have to share it with people. Disadvantages include there's limited expertise, so maybe you're really good at one certain area, maybe marketing of a business, but maybe you're not so good at the financial side or organizational side, and so that kind of limits your expertise on how to properly run that business. Initial startup / expansion costs falls to one person. So like we mentioned with an entrepreneur, a sole proprietor needs to come up with those financial resources on their own. So whereas if it were multiple owners involved, everyone could kind of pitch in, but sole proprietorship, it's just you. And also another disadvantage, in case of loss, the entire burden falls on the proprietor. So again, if the business goes under, all that loss again falls on your shoulders. Okay, another type is partnership. A partnership is where there are two or more people come together and start a business based on an agreement. So this has a little more paperwork involved just because there's some legal papers drawn up to make sure everybody's on the same page and everybody agrees with the structure of the business and how it's going to be run. Advantages, again, it's pretty easy to form as compared to corporations, which we'll get to in a little bit. Easier to mobilize funds since there's several partners involved, then financially you're going to be a little more stable. Multiple skills, expertise. So instead, maybe again, you're an expert in marketing, but your other partner is an expert in accounting and finances, and the other one's better in organization of the business. That kind of will help the business overall. And then you're also sharing the risk or the loss should the business incur some loss. Disadvantages, so if you're sharing the loss, then you also have to share the profits, so that's kind of a downfall. More of a delay in decision making just because it has to be run by all the partners to make sure that everyone is in agreement. And disagreements could lead to business dissolution. So if there's something that you and your partners can just not agree on, then it could end with the business being dissolved, which is never good. Okay, then corporation is a publicly held registered organization. And these are going to be kind of the most complicated type of business to start up. So let's kind of break it down a little bit. A corporation has 5 main rights. They can sue and be sued. So this gives the right, where is it going? Okay. Gives the right to seek or pay damages to a party. So someone could sue the actual corporation, whereas a sole proprietorship or partnerships, and someone had an issue, they would be suing the owners, not the corporation as a separate entity. A common treasury holds assets separate from the assets of members. So there's separate things that the members own versus things that the corporation own are separated. Hire agents, the right to hire employees. There's a common seal, which gives the corporation the right to sign contracts, make bylaws, form its own rules and laws to govern internally. Oops, misspelled. So basically the corporation, once it's established, it's its own individual, basically, and unlike the sole proprietorship and partnership. So some legal characteristics. Transferable shares. Membership can change without affecting the existence of the corporation. The shares are partial ownership of companies. If you were in our personal finance class, you might remember this. And shares can be transferred without a lot of hoops to jump through. can continue to exist despite the withdrawal of its members. So you could sell your shares and buy shares, and there could be people coming and going, and the business would just continue to exist without a lot of complications to transfer that. Limited liability. The responsibility of the members for the debts of the corporation is limited. So should the corporation fail, it doesn't all fall on the owners. It's that limited liability, which meaning your liability towards the company, or what you will have to contribute, is limited. Okay, and some advantages of a corporation. Easier to mobilize the capital to initiate the business. So again, instead of relying on one person to come up with the funds, it's a lot more partners and a lot more people involved to get the funds going because of shareholders and investors and different things like that. Which also makes it easier to expand, because you can just kind of call on your shareholders or investors and they can put more money into expansion of the business. Loss incurred would be minimal per shareholder. So since it's all kind of spread out between hundreds to thousands of people, depending on how many are involved, the loss is a lot more minimal to each person. But some disadvantages: it is a lot more complicated to start up. Lots of legal formalities as opposed to a partnership or a sole proprietorship, and much higher tax rates for a corporation than the other businesses we mentioned. Okay, so no matter what the business you have, in a business, various people use the data in financial reports for different purposes. So with accounting, like we said in the previous video, we generate these reports so that people can make decisions based off the information in these reports. And they're used by many different people. You have some internal people. This would be like people within the organizations, owners, managers, employees. They want to know the expected profit financial position of the organization. So there's going to be some reports and forms that are open to the public so that they know kind of where, again, the financial position of the company. And then external people, this would be like tax authorities, financial institutions, creditors. They're going to want to see that data as well. So tax authorities would use it to assess how much tax should be levied based on the organization's income. So they'll determine how much that company owes in taxes. Financial institutions loan money to organizations. So basically a bank is going to want to see your financial data in order to determine whether or not you're a trustworthy organization to loan money to, and making sure that you'll repay them for sure. And same with other creditors. They're going to check to see if the business has a repaying capacity. So what do they have for assets or like collateral that they could give up in order to receive loans. Okay, then there are 3 basic accounting assumptions when it comes to accounting. So then there's the business entity assumption. So this implies that a business is separate and distinct from the person who supplies capital to it. So you will see when we start to really record transactions, there's going to be, there's not really a personal account. It's the business, and then the owner is something separate. So when we're keeping our records, you'll start to see that there's really distinct recordings of the business transactions and then personal transactions. This just helps to assess the business's true profitability. So it really helps you to separate the two to make sure that you're only looking at the business and whether or not it's making a profit. The accounting period assumption. The life of the business is divided into specific periods for reporting purposes. So this is for all businesses. Most businesses have an annual reporting cycle, but they could do it like monthly, quarterly, semi-annually. But the most often is annually. So that's kind of what we're going to be using in this class. And the going concern assumption. So a business will continue to operate indefinitely and will be able to meet contractual obligations. So what that means, basically, so when we're recording transactions and we record that a company bought machinery and the life expectancy is 5 years, we're going to divide the cost out over that period of time. So these are the assumptions that we're going to follow as we go through this course. Okay, your next task is you should be completing the study guide as you were watching this video, hopefully, and then we will review for the Unit 2 exam at the next Class Connect. So come to the next Class Connect. You should have all the information you need to complete the study guide, which will definitely help you for the Unit 2 exam. So when you come to the next Class Connect, bring any questions that you have over this last unit, and we will get those answered for you.